Hello and welcome to the CNBC TV 18 special. I'm Shereen Bhan and we're back again here at the Kotak Mahindra headquarters in Mumbai for our annual conversation with Uday Kotak ahead of Kotak's annual investor conference, Chasing Growth 2019. Mr. Kotak, always a pleasure. Many thanks for joining us. How concerned are you about growth today? The theme of the conference is Chasing Growth, but how concerned are you about growth today? Because again, between what you hear and what the policies are being rolled out, you've seen sort of a fiscal stimulus come by way of the interim budget. There's been a 25 basis point cut. How that transmits into the system is still a question mark, and whether it meaningfully changes the needle is a question mark. But are you concerned about chasing growth today?
No, I think we need to have much greater ability and capacity to grow faster than 7%. And I've always believed that India has the fundamental capacity, and we need to create the on-the-ground capacity to be growing at somewhere between 8 and 9%. And at this stage, 7% is where we seem to be stuck at. And disproportionate load for this 7% growth has come on government spending. Time has come for kick-starting private investment. I remember on one of your shows 4 years ago, I'd said animal spirits.
Animal spirits, yes.
And we really need to get it back.
So what's gone wrong? You said 4 years ago on my show that there is a need to unleash the animal spirits in corporate India. How much would you attribute the fact that we haven't seen that release on account of the mistakes that corporate India has made? And how much would you say has happened because there hasn't been that policy push that was anticipated?
No, I think we also went through some very path-breaking change. And three major changes have happened in this period. One is demonetization. So there was a...
You still call demonetization a path-breaking change?
No, I'm not commenting on the positives or the negatives. I'm just making a factual statement on that. It did take energy of the system. And it took 6 months, 9 months for the system to settle down post the demonetization period. Second is GST. Which happened about 8-9 months after demonetization. Again, the system, it was path-breaking. It took time to adjust. The third path-breaking change is IBC. And IBC was a completely new law, untested, and we introduced it. I think fundamentally a good law because it shifted the balance in favor of creditors versus debtors. But as we have gone along, we have found a number of legal challenges, establishment of jurisprudence. So all that has taken a couple of years for us to really settle down to this, and I think it's still settling down. So these three changes have taken up a disproportionate part of the public space in the reform arena, and we are therefore in the 4th or the 5th year of some of these changes which have happened. And as the system gets adjusted to post-friction world of these changes, we think we will see a better outcome and hopefully ability to grow faster.
So on balance, keeping in mind all of these factors that you've pointed out, where does business confidence stand today?
I think business confidence also has to wake up to the new world reality. Indian businessmen have been tuned to a particular way of doing business. And in this 24/7 media world, and electronic world, business has to realize there's nowhere to hide. You've got to go out there and do the right things and be transparent about what you're doing, because there will be no place for you to do stuff which you could get away with in the past. And this is again a part of the frictional change which Indian business is adjusting to. And while it is adjusting to it, you're seeing some of the animal spirits get affected and not driving new investment in a hurry. And in fact, the time is perfect now because capacity utilizations have moved up. We are closer to 80% capacity utilization. I think this is the time for India and the private investment to really kickstart. And if at all, start planning now and get going.
So, as you said, that growth has largely, A, been consumption driven, B, it's largely been on account of public spending. So as you look ahead in 2019, and we of course will be in the midst of an election in a few months, and we will have a new government in place in the first half of this year, what would you anticipate? Which are the sectors that you would bet on given these various factors?
I would really like to believe that private investment is the place to be. And if we can kickstart the economy with private investment, there is no better time than now, because any investment now will take 2 to 3 years, by which capacity utilizations will be probably somewhere in the 90s, and there will be pricing power for people who put in capacity. So I think it's a great time to put in, and I would really go into building some of the core Indian manufacturing side combined with infrastructure. And infrastructure has been a bad word for 10 years.
Yeah.
One of the things which has dragged India's growth is infrastructure has been quagmired. We've seen a lot of problems in that, some of which I am seeing at closer hand.
Yes.
So this is the time for, first of all, reviving those stuck infrastructure projects to capacity, and at some point of time finding a way of breaking this logjam on infrastructure.
How confident do you feel of being able to break the logjam in infrastructure? And I ask you this in the context of what you're now supervising with IL&FS. A, how much worse is the problem than we understand it to be now that you've had a closer look at what's happening there? And how long will it take for us to put this behind us systemically?
Yeah, I think on IL&FS, let me first say that we've looked at the entire gamut of companies under that umbrella with a very wide array of businesses, and we've made some progress in terms of figuring out the nature of exposures of each of these companies. We've come out with this unique concept of green, amber and red companies to really define the status of each of these companies from a creditor exposure point of view. We have put a lot of the assets for a potential resolution or monetization, so most of those are out. So we do believe that in the next few months we should be in a position to start some of those monetizations. And having said,
will anything get done in this calendar year?
In this calendar year, I think we think a lot of it will get done in this calendar year.
Okay, so a lot of
fiscal calendar.
No, calendar year. That's why I said calendar year. Yeah. So you believe that a lot of the asset monetization on the IL&FS side can go through in this calendar year. 22 companies have been classified as green. How many more of that long list, that plethora of companies and SPVs, do you believe that you think can be on the verge of turning around, and by when?
See, so far I think the analysis has been done by the resolution professionals as submitted to the board, which is about 69 companies, out of which 22 are green. But between these 69 companies, it accounts for 92% of the debt. There are still a few hundred odd companies domestically, which analysis is on, but it's only about 8% of the debt. All the foreign companies have been declassified out of moratorium from an Indian point of view. So we are getting a sense of declogging. So the balance 100 companies we will be able to identify in the next few weeks and classify them into green, amber, red. So we will have the full list of what we think are green, amber, red companies. The question then is, as resolution happens, the whole process of resolution is under section 241, 242, not the traditional IBC process, which is a whole new process which is being worked on by the government and IL&FS together, which is a unique Indian process for group resolution. So far in India, we've never dealt with a group resolution situation. We have dealt with individual companies. So this is a new path we are treading forward, and we think that we will at least be able to ensure greater transparency about the truth of what's happening at IL&FS, and we think a significant amount of it will get resolved and monetized in this calendar.
The role of the rating agencies, and this is something that the Parliamentary Committee on Finance is also looking at, the government and the regulator also in dialogue on this, especially in light of what has happened with IL&FS. What's your own take on the need for a review?
I think whenever you have a situation like this, we really got to look at the role of at least six categories: managements, boards, institutional shareholders, rating agencies, auditors, and of course the supervisors. So I think IL&FS will lead to a significant evaluation and introspection of the roles of each of these in the days ahead.
So need for an overhaul as far as regulations are concerned, especially when it comes to the role of rating agencies?
I think who is accountable for the raters and what is the basis and the rationale for the rating is something which will come under focus, because it is worrying for a system that a company is rated as AAA in August and is D in September. So we need to ask the tough questions on the basis and the rationale for the ratings.
But have you got the answers? I would imagine by now you've asked the tough questions. What is the answer?
I think, again, if you ask the raters, probably they may have been depending on the pedigree of the institutional shareholders, on the basis of which they believe that should there be a need for capital, institutional shareholders will necessarily bring in the capital. Now, in the case of IL&FS,
were they led to believe that?
I don't know, and I'm not in a position to give a judgment on that. But in the case of IL&FS, the government shareholders were not majority. Therefore, it was not a 51% government-owned company. And the government-led institutions were minority shareholders. And therefore, we have to then ask the question on the justification of the rationale.
Okay, that's as far as the rating agencies are concerned. But given what has happened in the system on account of the crisis of confidence post IL&FS, how much of that do you believe continues to be an overhang? And by when do you believe that we could see this logjam that you spoke of being broken?
Shereen, one of the issues which came out in IL&FS and maybe concerning markets post IL&FS is what I call as interconnected exposures. Therefore, an exposure given by, say, an NBFC to a group real estate company or a real estate company, or some arrangements which may be between two companies which may be not necessarily at arm's length, or lending or investment in very illiquid situation with short-term funding. Some of those issues are what may be concerning markets right now.
Are more accidents waiting to happen? Is that your indication, your assessment?
I will put it this way, that the current situation is fragile. However, I do not see a systemic problem if well handled.
When you say you don't expect a systemic problem if well handled, when handled on whose part?
I think certainly on the part of the policymakers and the regulators, but combined with responsible market behavior.
But what can the policymakers and the regulator do in this environment?
No, I think there are different ways of handling this. Number one, I do believe that with, for example, the inflation levels, CPI inflation levels yesterday, there is room for more reduction in short-term rates. That can certainly help the system. And I think it's important to keep the liquidity pretty comfortable in the system.
Is it not comfortable? Because we just heard from the RBI at the...
No, I'm saying, I think what we got to ensure that it continues in the month of March, which is an advanced tax and a busy month. So we need to maintain good liquidity, ensure that interest rates reflect CPI, which is certainly soft.
How much of it is a liquidity issue versus a fear factor?
No, I think there is a fear factor. There's a fear factor. Back to the point I said, there is an element of fragility in the Indian financial system today.
And in order, again, of priority, what would you say what are the biggest concerns when we talk about this fear factor? Of course, one is, what has happened post IL&FS, the fact that there might be more accidents waiting to happen and some of the other imbalances that you spoke of. But what is at the heart of this fear factor? What's causing the fear?
Shereen, it's a simple thing. The system needs to trust balance sheets. If you cannot trust balance sheets, there is a problem. And time has come for everybody to question that how trustworthy are Indian balance sheets. Until we get a good answer, good answer can come either from auditors or from the regulators. And without that trust, you will always have the fear factor.
So then, is there light at the end of the tunnel anytime soon?
So the system is making a difference. Wherever you trust balance sheets, the system is looking differently. Wherever you have concerns, the system is punishing disproportionately. Therefore, the price of uncertainty on the nature of the balance sheet is costing many companies.
So what will this then also mean as far as fund flows are concerned?
Fund flows are just
into the Indian market.
Fund flows.
I mean, the flight to safety is what you've already
and
spoken of.
And it's getting narrower, which is not necessarily a good thing from a long-term point of view. But I do believe that for us to be able to get the fund flow both from domestic and international investors is back to investors being minority investors to trust financials and true governance of companies in this country.
You know, I want to address the NBFC issue systemically because there has been talk on a possibility of a review as far as the norms governing NBFCs are concerned. I don't know if any conversation has happened between you and the regulator or you and the government in the context of what we've seen happen with you supervising the IL&FS board. But what would the road ahead be, and is this the right time to do that?
We can discuss the timing, but just go back to a coincidence. 1997 was the Asian crisis. Indian NBFCs and the financial sector started having serious stress in 1998 all the way up to 2002, 2003. Similarly, we had the global financial crisis in 2008, and you saw the stress in the Indian system out of that in 2008. And exactly 10 years later, we are seeing some cracks which are coming into the system. So this is a 10-year syndrome, and we need to constantly move ahead, take corrective measures, because the system tends to get excesses, and that's what is happening. So 1998, 2008, 2018, 19.
You know, in the context of this 10-year cycle, we're also now at the one-year anniversary of the RBI 12th February circular. How have you assessed the developments post that and where we stand today and where we could go from here on?
I am a believer in transparency, fundamentally, and let it be spoken. And true balance sheets need to be disclosed. If something is not true, we need to discuss and we need to see it transparently. The only issue about transparency is when you change a system or purge a system, there is, as I mentioned, significant frictional cost. So when you're moving towards a more transparent system, the only question you ask is, do you do it one shot or do you evolve into it? That is the matter of debate, not the end state, which is a transparent system. Therefore, should there be a period of evolution, or do you say one day this is the decision? Not the fact that we are in the right direction.
Speaking of direction, and you spoke of infrastructure and manufacturing as being bets that you would like to sort of focus on as we look at chasing growth in 2019. Outside of that, what are the other sectors that you believe, both in terms of valuations as well as the growth outlook, look interesting?
I think financial sector, as I mentioned, since it is in a fragile zone, would see significant consolidation. Now, consolidation, some of it will happen through mortality as well. Therefore, I believe we are going to see fewer players going into the future than what we have seen in the past. It reminds me of 1998. There used to be 4,000 NBFCs. 5 years later, we were down to, out of those 4,000, serious functioning ones, barely 100. So we saw significant transformation in the NBFC sector.
You expect that kind of a shakeout?
I think the shakeout is going to be pretty significant. I'm not saying the intensity will be as much as it was in 98 because prudential regulations have moved significantly since then. But consolidation in the financial sector, the time has come. And one of the things I would really like to see with the new government is a long-term structural solution to public sector banking in this country.
You know, this has been your pet theme and you've spoken about this for so long, and we've seen absolutely no movement towards that. There was the idea of a holding company, there was the possibility of the government actually looking at bringing down its ownership. None of those things have actually transpired. What we are instead seeing is efforts to consolidate public sector banks and make a smaller public sector bank into an even larger conglomerate. Do you really still hold out the hope that we are going to see any significant change here?
I think we reach a point when necessity makes us take the right calls. And I'm not, as I've mentioned earlier, I'm not necessarily saying sell it to private sector. But make it broad-based. Why do we need to have government ownership of more than 50%? Why can't government ownership be 26% and the rest be widely held public? And in the short run, if there is a concern of potential fear factor in depositors' minds, the government can give some comfort on guarantees for a period of time till the confidence is established. So systemic move to dilution of shareholding in public sector banks with a transition to give comfort to depositors could be a way forward.
Has this been a disappointment for you, the fact that we haven't moved on this front at all?
More than disappointment, I believe that the lending capacity in the system would have been better if some of these decisions had happened over the last 10 years.
Speaking of ownership, and I know that the matter is sub judice, so I won't press you to give us details. But, we've had this conversation in the past, and you do believe that the better thing for ownership when it comes to banks is that the promoter should have skin in the game. And you believe that regulations that disallow that perhaps are to the detriment of the banking sector.
Shereen, you're talking a language I've talked for a long time.
I said that. I said this is basis our conversation.
It would, however, at this point of time, considering that the matter is sub judice on matters of law, it's better I don't speak about it.
Well, you have to wait till March, which is when the next hearing is, to get some indication of where this is headed. But if it were not to go your way, what then?
I don't want to speculate.
No, I'm not. I'm just saying that if it were not to go your way, what then? Do you have the plan B already in place that you will set in motion then?
At this point of time, the matter is sub judice. I would not like to comment.
But do you have a plan B that you will set in motion if that were to be the eventuality?
Shereen, let's see how things develop.
Okay, fine. I won't press you further on that. But as far as your own NBFCs are concerned, given what we've just discussed as far as the current environment, what is the outlook and what is the future for those and your aspirations there?
These are our current NBFCs are subsidiaries of the bank,
right?
And we are in a very comfortable position. So overall, when I look at the bank and all our subsidiary businesses, we actually feel very good that we are in good health. We have been prudent. We have handled our balance sheet with care. And we actually feel this is a good time for us to be growing well and growing faster.
So what's the outlook as far as lending growth is concerned?
We have guided and we continue to guide at 20% plus growth in lending.
I revisited our interview that we did exactly this time last year, and some of the red flags and concerns that you had raised, specifically when it comes to mid-cap valuations, and you anticipated that we could see significant pain. That's exactly what we've seen happen. You raised the issue as far as India losing out on the corporate governance premium, and this was then on account of what had happened with PNB, and since then things have gotten considerably worse on the corporate governance front. And you'd also then raised issues and concerns about what we were seeing happen in the real estate sector and valuations with NBFCs. So you pretty much got some of those themes that are now playing out right. In order of priority, which ones would you be most concerned about today?
I think at this point of time, my personal view is the SME, the small and mid-cap sector has already seen a lot of the pain. And the pain from here may not be anywhere near the pain people have seen in 2018. Therefore, I do believe that small and mid-cap maybe have adjusted more compared to what we have seen in larger caps in general. And I think there has been a flight to safety. A lot more money has moved into larger cap and fewer number of stocks in terms of the marketplace. My concern at this point of time continues to be in the residential real estate space, which I think is still facing its pressures. And it's back to fundamental affordability in many major cities for people to be able to really buy an apartment and look at financing it over a long period of time. Therefore, this correction, however painful, over a period of time, actually makes it far more affordable for individuals and consumers to get sensible pricing on housing. Okay. But in the short run, I think there's been too much of land financing which has happened, and that pain is playing out.
I'll address the real estate sector and your concerns with respect to that in just a second. But since you talked about mid-caps and you believe that 2019 is likely to be a better year relative to 2018, is that because of the price erosion that we've already seen, or do you believe that fundamentally things are starting to turn around for some of these companies on account of the pain and the overhang, for instance, of demonetization and GST that they've now been able to readjust to?
No, I think it's both. Number one, a lot of the price correction has happened. And number two, I think people take time to settle down to a change in a system. And during the change, there is a lot of frictional cost. So a lot of the frictional cost has happened. And I think going forward, some of them have been punished disproportionately. So there could be opportunity to really look at stock picking, where again one has comfort and trust in the numbers and the governance. One of the issues which minority investors continuously worry about is what is the truth. Can I trust these numbers? Can I trust these managements? Can I trust these promoters? Or some surprise will come. And as long as we can pick stocks where we don't have those surprises, I think that is the key.
How serious is that problem? You raised the issue of corporate governance and the fact that India was losing out on the corporate governance premium in our conversation last year. As we sit here today, how serious is that problem?
I think the issue really about the whole governance of listed companies in particular, we have got to keep the context. 2016 November saw demonetization and a flood of money come into formal financial savings. It started first with bank deposits. As banks dropped rates, it moved to mutual funds. And with much lower interest rates, there was a growth of money coming into equity funds as well as debt funds. In the case of debt funds, as they started chasing returns, NBFCs, rated NBFCs got disproportionate share. At the same time, exposure limits in February 17 per NBFC and HFC were totally increased from 30%, that is 25 plus 5 to 30 plus to 25 plus 15, totaling to 40. So concentration risk in the mutual fund industry with reference to non-bank financial exposures went up. And as easy money came in, a lot of that went into funding balance sheets of NBFCs. And to a certain extent, when you're in the middle of a party, you start putting money all over. And money went into different directions, some of which were very illiquid, and some of them were places where money should not have gone in the first place. And some of the pain which we are seeing now is a correction of this, and this is still not fully done.
So it could get worse before it starts to see
some areas
recovery?
The pain may not be fully done.
Which areas?
I think, as I said, real estate is one area which I would seriously worry about. Second is a lot of trading companies with very little core value add may have more pain to go in. And the third is, we still have to see how the telecom battle plays out between the three big players. So the question in people's mind is there room for 3 or 2 or only 1? So some of those issues will also get addressed between 2019 and 2020.
Okay. You talked about some of the excesses, and you said that because of cheap money, the party was on, and it looks like the party has wound down or is in the process of winding down now. Some of the excesses on the corporate side as well, we are now dealing with practically every week issues related to promoter pledged shares. What implications will that have in the next few months as you look at the current situation for the markets?
The whole debt levels against promoters' shares requires 2 parts to it. And first, I believe from an underwriting point of view, the system should have been far more cautious, where the percentage of shares pledged by promoters started going up above 50 or 60% of their total shareholding.
When you say system, who do you mean?
The lenders. Therefore, if the total promoter shares is 100, if the pledge levels started going above 50 or 60%, there was much lower cushion for safety. And in many cases, we have now seen that the pledge shares are as high as 70, 80 and 90%. So that is water levels being extremely high. But at that stage, you really need to look at the underlying business. And if the underlying businesses are strong, some of these need to be restructured and refinanced in a much smarter way than what the marketplace has done so far. What has happened over the last 2 years is NBFCs were allowed to finance at 2x cover. There was no such regulation for mutual funds. So mutual funds were lending at 1.3, 1.4 and 1.5x cover. So this arbitrage which happened between NBFCs financing against shares and mutual funds financing at lower margins is the reason why levels of leverage also went up.
So is there a need for regulation, or is there a need to review the regulation, especially when it comes to mutual funds? Because that debate is now back on the table in light of what we're seeing.
My personal view is that we should avoid gaps in between different institutions in terms of what are the levels of safety from a margin point of view.
Okay, so harmonize
Harmonize it.
Okay.
So either allow 1.5 times for all, or whatever that number is, between entities, we should ensure that there is some level playing field.
So given the debt situation that corporate India is faced with, and we keep talking about the twin balance sheet issue, which sort of has been the recurring theme for the last several years now, again, in light of where the economy is, in light of where you see demand, in light of the debt position and the demands that the market is making today, would this be one of the most significant red flags for 2019?
See, Shereen, one of the things is when I talk about, say, Kotak Institutional Equities Conference, and this is the 10th year, is chasing growth. And how do you chase growth without overheating the economy? How do you increase the capacity of the economy to be able to grow faster? And in that context, I feel that we need more steps to have the capacity of the economy to grow much faster than the current level of 7%. And that
has corporate India adjusted to the idea that perhaps 7% is the kind of growth that we are going to see, at least in the near future?
I think that is where the key issue is private investment. And we really need to kickstart private investment. And it is here that domestic promoter capital is going to be a constraint other than in a few hands. Because a lot of promoters have significantly destroyed or disrupted the core of their capital base in the last few years.
So then how do you see this private capex picking up?
So that is, I think, the key. I think the dependence on private equity. And here again, if from a policy point of view, one of the big thrusts we as a country need to give is creating a much larger pool of domestic private equity. There is a fair amount of global private equity, and I think we should continue to welcome it. But how do we create large pools of domestic private equity capital? And what are the policy initiatives we take to encourage?
So what are the policy initiatives that you believe need to be taken?
First of all, we need to really give domestic private equity an ability to get some sort of tax kicker for, say, getting into setting up companies or investing into early growth companies, say, for 3 or 5 years, and boost the ability of the system to...
But you're seeing what's happening with the startup ecosystem, right? With this issue of Section 56 and Section 68 and how VCs and startup founders are having to deal with, the angel tax.
I think we've got to really fix that piece, because key is private investment. And private investment today in India is disproportionately dependent on foreign savings. There is a fair amount of domestic savings which needs to be channelized. For example,
are you worried about the fact that the domestic savings rate is falling?
What I would probably suggest as possibility is, if you look at the insurance pools, we have quota for infrastructure, we have quota for government securities. We should seriously think whether there is a policy need to drive some money in private investment.
Theme over the last sort of 12 to 18 months, you said that it was, we were in a period of benign macros, then we went into a period where we saw crude prices escalate, and we perhaps have now sort of come back to a period of benign macros with inflation being where it is and where crude prices are. So would you now be specifically more concerned about the micros today?
On the macros, I think if you ask me what would concern me, is the level of monetization of the fiscal deficit, which seems to be happening, and that's well above 70%. So that's something which we should keep in mind. And therefore, my sense is the short-end interest rates look benign, but the yield curve in general will be a little steeper than what it has been in the past.
And the oft repeated demand of an aggressive rate cut by the Reserve Bank, perhaps even a move as far as the CRR is concerned. CII and FICCI both sent in recommendations of a 100 basis point cut. 25 is what we've got. Given the commentary from the RBI and the fact that we've changed stance, the MPC's changed stance, what would your outlook be on interest rates?
I would believe April has one more rate cut.
April has another rate cut.
That's correct.
And in terms of transmission?
I think transmission will happen as we go forward, as deposit rates drop. The only issue with deposit rates is currency in the system. So as cash in the system is going up, the flow of financial deposits has been constrained. And if we have credit growth about 20%, which is what we are seeing in our case, we have to ensure that we also monitor the credit deposit ratios. That means that deposit rate growth also has to be significant. And that is leading us to pay a slightly higher price on getting deposits.
And that is a challenge. So given the fact that you're going to have to try harder to be able to move the deposit rate higher, do you have the capacity then to be able to move on the lending rates?
So we will go by clearly what's our cost of funds and the marginal cost of funds. And I think between now and April, we should see the ability for the banking system to be more moderate on MCLRs.
How do you view this change as far as the RBI is concerned, saying that the proposed move as far as benchmarking is concerned was only a draft move, because one thought that that was actually where we were headed? So there seems to be a change of heart. How are you reading that?
So I think the move on external benchmarks was linked more to retail lending, and personally I welcome it. I don't see any issue with that. Let it be off external benchmarks. And each
bank, there seems to now be a pullback on the part of the Reserve Bank. What do you make of that?
But we are comfortable if they even brought it. So from our bank's point of view, we are quite comfortable for them to continue as is or to modify it. And we are comfortable if it is getting modified as well, because finally each bank has to be more efficient on its cost of funds.
Red flags as far as SME lending is concerned, do you anticipate more trouble there? Red flags on the Mudra loan front, which is again something that has been raised, and the performance is inconsistent across various banks. Retail, any red flags emerging in each of these pockets?
I think SME, my view is a lot of the pain is in the system and depends on where each bank is. We at our bank have recognized the pain, and we are quite comfortable growing our SME book from here in a measured manner. On retail, I think one has to watch for unsecured consumer lending, which has been growing at a very fast pace. And I do worry about that as a percentage of any lending book in totality. And unsecured lending, sooner or later, has its own challenges. I personally believe some of these challenges will come in end 2020, early 2021.
End 2020, early 2021. So we still have.
That's correct.
Any way that you believe we'll be able to mitigate that risk?
You got to start managing your risks, your choosing of underwriting, and tightening our underwriting standards on unsecured personal lending now.
Okay. You talked about the fact that you anticipate consolidation, you anticipate a big shakeout in the NBFC space, and it comes back to the question that I've asked you several times over as well. Your role as playing consolidator, given the current environment, do you have the appetite if you don't know the true balance sheet of most things?
Shereen, as you know, we did a major M&A in 2015 when we acquired ING Vysya Bank.
Yeah.
It still happens to be the largest private sector acquisition in banking. Our view is we need a complete deep down view of individual balance sheets before we buy anything which is big.
Have you looked at some?
We look at a lot of things all the time. So we don't like to play blind. We like to see the cards before we quote our number. So once we see that...
Have you quoted a number to anyone?
If we had and we had to make it public, you would have known.
Yeah, not to make it public, but negotiations, have there been negotiations that have been underway? You know the speculation that I'm talking about.
This, we have been living with speculation all the time, as you are aware. And
which is why I'm not naming them, but I know, you're aware of the speculation that I'm talking about.
The issue really is, we are not scared about taking risk, but we want to know what risks we are taking. And once we are comfortable with taking those risks, we will move forward if we get the right value.
What would you be looking at? What would decide whether you go ahead or not?
I think three.
Of course, you have to have a willing seller as well.
Of course. See, in any consolidation situation in the financial sector, you look at what is the value of the asset you are buying versus the price at which you are buying. Second is that a segment which you may want to strengthen? Therefore, 2 years ago, we bought a small microfinance company called BSS Microfinance, which enabled us growing in the microfinance space. Therefore, is there segments which we think we can get benefits post that acquisition?
Are there segments that you believe you can plug?
All the time. I mean, there are many areas where we could be better than where we are in across the whole range of financial services. And the third area is, again, is there enough ownership, is there enough customer base and franchise value which we would get out of that? So these are the three key things: the underlying asset value and the price at which we are getting it. What is it that we get as strengthening of the segments, particular segments which are of interest to us? And third is, what is the franchise value? Has
anyone come calling recently?
No, we have a pretty active M&A team which looks at opportunities all the time. But we like to be careful, selective, and take care of our shareholders' money.
But is the risk-reward ratio looking better today, given where valuations are?
No, it's. I think there has been some correction in the marketplace, so we have to watch the situation.
So I'll end then by asking you, Mr. Kotak, you know, since I said that what you told us in 2018, a lot of that has in fact panned out directionally according to the conversation that we had. As you look into 2019, you know, both the positives and the negatives, what would you have on your radar?
On the positives, I think there is financial sector post a structural change and a frictional change which it is going through. The players who survive will get much stronger and better. So that is one. Two, in the intermediate period, there will be pockets of significant fragility and pain in the Indian financial sector. Three, residential real estate is still a significant challenge. And four, watch out for retail consumer financing unsecured, which will create challenges in 12 to 24 months.
Okay, that doesn't sound very optimistic or very confident. Okay, that's all the red flags that you would watch out for. What would you be confident and optimistic about?
I think people are getting too concerned about elections. Markets don't need to be so worried about elections. We must look through this as a part of a 5-year cycle, and interest rates, short-term interest rates will be softer. Longer term will depend on how well we handle our fiscal and the price of oil. Therefore, short-term interest rates will certainly help the economy. And I think with the post-May government, whatever shape or form it comes, if they take some bold steps on the policy side, India could be in to step up growth from 7% to at least 8% over the next 5 years.
You know, since you spoke of the elections and you believe that disproportionate amount of time and attention is spent on by the markets on the electoral result and the electoral verdict, but what do you believe is the big concern, the big fear at this point in time?
I think markets are trying to figure out what's the nature of the new government in terms of, is it a coalition government, whichever way it flows, and what are the implications.
Historically, coalition governments haven't necessarily been bad for the markets.
So markets like to worry, and Indians like to worry too much about politics. We should really move.
So if it were to be a coalition government, what would you expect?
I think as long as we have some policy issues which are focused on, and there is an alignment between different political parties on that. Therefore, say the NDA or the UPA, but if you take the NDA and say there is a coalition partnership between the BJP and a few NDA members, as long as there's alignment of what is the way forward, I think things should be okay.
So the Sensex and the Nifty in 2019? I
would, always very difficult to predict, but I would certainly say higher than here.
That's a safe, easy answer. How much higher?
I wish I knew, but
no. How much ballpark? What's the kind of range?
My feeling is a lot of the pain has happened. I actually am beginning to feel that some of the mid caps may get to be more interesting in sometime in 2019.
Okay, we could see a mid-cap revival of sorts, but watch out for the balance sheets. That's the clear message there coming in from Uday Kotak as he speaks to us on the conference that they have annually every year on chasing growth, what it means for the Indian economy and for the markets. Mr. Kotak, always a pleasure. Thanks very much for discussing a whole host of issues with us. Always a pleasure, and thanks very much for your time.
Thank you, Shereen. Thank you.
With that, it is time for us to wrap up the CNBC TV 18 special from all of us here. Goodbye. Many thanks for watching.